Well, hey there, everyone. Happy Friday, February 13th. Happy day before Valentine's Day. And welcome to Chart This with Dave Keller, our Friday special all-mailbag edition. I'll be your host today, Dave Keller with Market Misbehavior. Thanks so much for joining me here and every weekday after the close as we evaluate market conditions using the best practices of technical analysis, behavioral finance, investor psychology, whatever other tools and techniques we can bring to bear to try to make sense of these markets in, I would say, noticeably uncertain times. Friday, kind of limping into the weekend. At the end of the week, or at the end of the day, the S&P and the Dow were essentially flat, and the Nasdaq was slightly lower. Action more in mid caps and small caps. Continued rotation away from growth into defensive sectors, and also some value. Utilities back at the top of the leaderboard. Breadth conditions not bad, but the trend is weak enough. Looks like our short-term market trend model will finish the week bearish now for, I think, the third time in 2026. Third time in the last couple months. Last couple times we've seen a nice bounce higher after that short-term bearish positioning. By the way, our Market Misbehavior Premium members will be digging in with you over the weekend in our weekly flight plan about that market trend model and how that might impact our thinking about market conditions here into the month of February. So never too bad a time to check that out at marketmisbehavior.com/premium. And if you do check it out, don't forget to use the code YouTube. All right, on Friday, what we're going to do is do mailbag answers. We've got some really awesome questions from you guys so far this week, and I can't thank you enough for taking a moment when you watch this show to drop a question in the comment section on our YouTube channel. Please keep them coming. We welcome your feedback on the show, welcome your thoughts about the markets, but very much welcome your questions. That helps us to think about how we want to focus our time together every trading day, and also gives us some really good content to talk about here on Friday, February 13th. We're going to start with a brief rundown of what happened in the markets today, a little abbreviated, and we'll get to some thoughtful questions from all you guys. Choppy day here. And, by midday, it looked like there might be a bit of a run going as the S&P teased 6880, but that was about it around 12:30 p.m. Eastern. We hit that again around 1:30 p.m. Eastern, but by the close, we're right back at the previous day's close, right back to Thursday's close. So directionally, the market moved very, very little in terms of the S&P 500, essentially flat for the day. Mid caps and small caps, much more impressive, up about 0.9 to 1.1% for those indexes. VIX is going to finish the week just above 20. It dipped below 20 midday as equities were rallying, but as they sold off in the afternoon, volatility pushed higher. So this isn't an extreme VIX reading, but it is above our initial line in the sand at 20. So I think that's something that we have to keep in mind as we go into this weekend. Thursday and Friday, both with a close above 20 for the VIX. Looking elsewhere, bonds continue to rally as there's a bit of a flight to safety here. The TLT was up just over 0.5%. Rates continue to move lower. The 10-year yield is around 4.05, we'll call it. Long bond yield around 4.7% now. Dollar index essentially flat today. Gold and silver having a nice bounce higher. Not a huge move, but nice recovery day after yesterday's deterioration. The GLD and the SLV, the gold and silver ETFs, both up about 2.5 to 3%. Crude oil slightly lower. Energy ended up being one of the mid-range sectors today. Cryptocurrency is not bad. If you look at Bitcoin and Ethereum, showing some signs of life here. Bitcoin currently trading right around 69,000. That's up about 4% from yesterday. Ether back above 2,000. On a sector basis, as I mentioned, it's utilities, real estate, and healthcare, three of the defensive sectors at the top of the list. Utilities end up having a monster week with the XLU up 2.8%, real estate up 1.5%, healthcare finally showing some strength here, up about 1.1%. If you ask me what's changed in this market here in the month of February, I would say the improvement in defensive sectors has been a big shift. Through the end of January, utilities, real estate, consumer staples, not particularly strong on a relative basis. All of those sectors outperforming so far in the month of February. That's been one of the most dramatic shifts that we've observed, is improvement in defensive sectors. A lot of big banks getting dinged today. If you look at the heat map, you'll see what I mean. But financials and communication services, also consumer discretionary, basically finishing the week flat for the day. we don't have time to go into too many individual names, but I'll point out Coinbase with a pretty decent reaction to earnings. That's up 16.5% today. Oh man, I'm kicking myself at the end of that stock picking exercise with Tom Boley and Grayson Rose. I was ready for my last pick, and I said, you know what, 2 names I want to get out there because I think they could be great bottom fishing ideas. Microsoft was number 1. Coinbase was number 2, basically buying a test of long-term support and banking on a good earnings release. Boy, that played out. Not that I made the bet, I sure didn't. And the mega cap growth trade still struggling here. Netflix, the only name really moving up in this space, and that's been the worst chart here in 2026 by far. Apple, Nvidia, both down over 2% today. Broadcom down in that range as well. So we have sort of a doji candle on the S&P. This is as we're testing key support. I have a question about the S&P, so I'll save my comments about that chart until we bring up the question. But going into this week, I mean, I'll share in a lot more detail with my premium members, sort of a high-level review of conditions. But one of the things that stands out is in 2026, the advanced decline line has been trending steadily higher. That speaks to the fact that the breadth has overall been fairly robust here. But look at offense versus defense, very clearly favoring defense. So a lot of stocks are going up. It's just the more defensive, more value-oriented stuff that's working. And we're in a situation where the NASDAQ can be down, the S&P can be flat, but plenty of value-oriented sectors are doing quite well. And that's pretty much how I would describe this market right about now. All right, let's get to some questions. As a reminder, all these questions come from viewers like you in the last week. Just taking a moment, dropping a comment on our YouTube channel with some questions. Please keep them coming. Let's get to question number 1. Dave, do you suggest holding stocks over earnings in general? If you are already in MAR, that's Marriott, what would you do? Hold or exit? So great question, and thanks for that. So 2-parter, right? Let's start with Marriott, because that was a stock that you brought up. Yeah, so I get what you're saying, and you dropped this before they reported earnings this week, I think is your point. So you're saying, like, here, would you hold Marriott knowing that there's this big earnings release? So the answer to that, and the answer to the first part of your question of holding stocks over earnings, it really depends on your time frame, right? And I think, if you're getting nervous about holding stocks through earnings, that would make a ton of sense if you're a swing trader. If you're really betting on short-term fluctuations, on tactical movements, so that binary outcome of earnings can be a huge deal breaker, right? Because you're betting on a swing, and if that swing is interrupted by a big sudden move, all of a sudden, it's like why even take a bet on that kind of chart? So, if your time frame is generally shorter, holding stocks through earnings, I would say, is a dangerous proposition unless you have some sort of conviction on earnings that you're holding that stock to make a bet on that earnings release because you feel like you have an edge that others may not. For me personally, I'm not studying these companies' fundamentals or analyst recommendations deeply enough to feel like I have an edge on whether the company is necessarily going to beat earnings or not. So for me, that's not a bet I'm probably making. But if you're a little more longer term, right? If you're looking out a couple months to a couple years, we really shouldn't be that worried about earnings moving. And that's the way that I kind of think of it, right? I think of charts related to earnings as helpful for a couple reasons. Number one, just getting the sense of sentiment going into earnings, right? So Marriott, for what it's worth, showing a lot of optimism going into this week's earnings report. And we can validate that. We can quantify that by the fact that the price is going higher. And just going into this week, we're breaking to a new 52-week high. So that has happened. And even this week, we've had examples of where, stocks are in an uptrend and then earnings pop and then, the stock just gaps down aggressively. That happens, right? And usually a company that's been doing well for a while, there's going to be that earnings report where finally the company just doesn't meet these increasingly optimistic expectations. And then we have to reset the valuation and the stock gaps lower. So that can happen. There's no guarantee. But I think it's helpful to know there's optimism going into an earnings release. I think you're seeing that on the chart on Marriott. The second part to where charts can be so helpful is seeing what happens afterwards. And this is where I think people underappreciate the benefits of technical analysis, right? So here's Marriott gapping higher after their earnings release. Here's the stock going higher, which means that gap all of a sudden is a very meaningful range to keep an eye on. I often draw like a little rectangle on that gap just to remember that that's probably a pretty good, kind of support zone or a congestion area, right? Some sort of level where that has meaning because we went from one point to another point overnight based on this new information, right? This quarterly earnings release. So what happens after the gap is pretty meaningful. For now, I would say, has Marriott been super bullish after that earnings release? The initial gap higher, yes. That day's close, yes. But what about Wednesday, Thursday, Friday? I mean, not really, right? We're actually closing lower each of those subsequent days. So there was a ton of optimism immediately after the first session after earnings. But was that release, was that optimism playing out through the course of the week? And the answer is no. You actually start to see signs in the last couple days of investors selling into that strength. So what you're looking for after an earnings win is a gap higher and then further buying, right? We want to see additional demand. We want to see investors that are now even, happy to buy it at 330, but also happy to buy it at 350 or 360 or 370. That's what causes the price to go higher. If the stock gap's higher and then falls, that's what I call a gap and fail. That's usually a really bad sign. That means there was optimism and an initial gap higher, but then it wasn't met by additional buying. The only way the stock continues higher is if there are additional buyers that come in. And Meta is a great example of that gap and fail issue, right? Remember when Meta had earnings in the initial day, it was like huge win, right? Huge earnings a couple weeks ago, big win out of the Magnificent Seven. It was like, wow, Meta, and this was the same day where, remember, Meta gapped higher and Microsoft gapped lower. So there was this big, one of these worked and one of these did. One of these had great earnings, one of them did not. But the problem for Meta is from that moment on, that's been it. There's just been selling from that point on. So people sold into that gap higher. It broke the 200-day. It failed again. So all the technical evidence post-earnings since that gap has been very negative. And so, I'm usually pretty comfortable just because as a position trader, I'm not looking to play earnings. I'm not looking to sort of trade around an earnings release and have that be the point. I'm hoping that earnings provide further information that causes an uptrend to continue, right? And that's where you have a long uptrend and you have these random gaps in there. A lot of those gaps can be good earnings releases where it's it further validates the bull case. That's kind of what I'm hoping for. And if it's a gap lower, I don't worry about the gap as much as I worry about are we holding levels of support? Are we gapping below a key moving average? Using the best practices of technical analysis to validate whether that gap lower is a problem or isn't it. So those are some thoughts. And again, whether it's right for you, that's a question only you can answer. And I would say your time frame is probably going to be one of the most important factors as to whether you're comfortable holding stocks over earnings. I always, when people talk about owning stocks in their retirement account, being worried about earnings, my comment is always, if your runway's far enough, you shouldn't be that concerned about what happens with earnings this week. You should be betting more on the long-term play. And if the long-term picture changes, the chart's going to change. And that's when you want to be concerned. Great question. And thanks for that. Next one. Are you considering moving up your yellow-red stoplight border to 6750 to 6800? It seems to line up with the highs of the huge reversal days of 1010 and 1120. Let's take a look. This is the chart of which you speak. And you were saying, oh, I see what you're saying. You're saying, would you move this up and say, hey, maybe here's the new yellow line, right? So, yeah, this is where the Dave Keller proprietary chart shading technique, it becomes pretty subjective, right? Levels like this aren't meaningful forever. And usually what happens is we end up breaking out of the range. The picture changes. We have a new uptrend. We have a new downtrend. And all of a sudden, this framework is not, it's not permanent. It's a temporary read on things. The way that, and I guess, so the short answer is no, because I would say if we chop around between here and 6550, I still see that as okay. As a long-term, assessment of trend, that's still okay. Is it great if the S&P is going from 6,900 to 6,600? No, I would not say that's great. But is it the end of the world? No, we're still above the 200-day moving average, which is going to still be sloping higher at that point. So remember, in terms of the long-term, trends, long-term trends still fine. And I would say even if we chop around in this yellow shaded area for the next month, I would still see that's still pretty good. In the short term, yeah, that's going to be bad. So maybe this is a short-term level. I guess what you're asking is, is that a meaningful breakdown? And maybe, I don't know if I would bump up that entire shaded area, which I still think is pretty important, but like, is like this the new kind of short-term, like tactical low? Maybe. I don't mind putting that on there. And that's what happens, right? Is within this kind of larger structure, there are smaller movements, right? Smaller sort of swings. And what happens, and I would say, as a trend persists, and as you have an uptrend that continues higher, we should be bumping up our stops, bumping up our lines in the sand. I haven't seen this here as enough of like a big upward surge that I think you need to bump up your stops, at least in terms of the timeframes that I'm trying to illustrate here. But I get your argument. This is subjective. So yeah, I'm going to do this. I'm going to have both. I'm going to have my cake and eat it too. I'm going to keep these initial lines here, but I'm going to add, here's a secondary support, which I think is fair, right? That's sort of like 67, 80, 6,800 level. I mean, if we break below that, I mean, I'm not going to count that as a good thing, right? That would be bad. I just think it's a less bad than if we get below here. That's the real red light. That's still like maybe a deeper yellow. I'm getting into semantics, but that would be my argument. So yeah, I would say in the short term, that's a good, I would call that a tactical level of support. I think the structure we've been talking about with over 6,900 is good, below 6,550 is bad. For me, again, thinking a little more longer term, I still think that's an appropriate way to think about this trend. And it really more lines up with my market trend model, which really is based on weekly S&P 500 data. And it's really, I'm looking at that red, yellow, green. I mean, I'm really more thinking of like the medium-term model, because that below the 200-day moving average probably puts the medium-term model bearish for the first time since May of last year. So I think that's why it's kind of, I see those lining up in similar, it would take similar amounts of negative movement to trigger both of those indicators. I hope that makes sense. Next question. Are cryptocurrencies still a good barometer for risk on or risk off for the rest of stocks, or has it outlived its usefulness? It's an interesting question. I guess the real question is, was it ever a great barometer of risk on and risk off? And I would argue no. Has it at times been a good barometer? Yeah, it's a sometimes. And so maybe that's good enough. One of the ways we can check that, by the way, is bring up Bitcoin. Like, how well has it mapped with stocks? So I have a chart here where I can do correlation to S&P. All right, so here we're looking at Bitcoin for the last 2 years. I have the chart of Bitcoin here. I'm doing the 20-day rolling correlation with Bitcoin and the S&P 500. So if you know correlation coefficients, right? So a correlation is kind of just trying to define the relationship between and just how closely these things tend to move is my non-statistical way of describing it. So, and correlation is never going to be perfectly positive at a value of 1, but up in the 80, 0.8, 0.9 is pretty remarkably strong. Down at -1 or like -7, 8, 0.8, 0.9 would be a strong negative correlation, meaning when one thing moves up, the other thing tends to move down and vice versa. A correlation right around 0 basically means there's no clearly defined relationship between the two. So here's the kicker, right? So at times you can see that these are in a pretty good, strong positive correlation. It's about a 1-month look back here when I'm looking at this correlation. But then there are also times when there's literally no discernible relationship between the two. So like May, June of 2025, Bitcoin and stocks were kind of doing their own thing completely. Back here in mid-2024, there was actually a strong negative correlation because the S&P was going higher and Bitcoin was trending lower. So is there a generally slightly positive correlation? Yeah, like the general average is probably like 0.5. That's not a strong positive correlation between the two. So the reason why I show you that is it's not as close of a relationship as I think a lot of people would think. Generally what I see, and we've just seen that in 2026 so far, right? I mean, look at where the correlation was a couple of weeks ago. It's literally right at 0 because, Bitcoin's rolling over, as are all the cryptocurrencies, and stocks aren't. And this is probably why you're asking this question. Does it still make sense? My answer would be, it hasn't been as consistently positive as you would think. Look at all these other times where that's generally happened. And that's often been because Bitcoin has pulled back when the S&P has not. And that's when there's generally been a strong, or like the absence of a strong correlation. I mean, I still think it's interesting because I would think of Bitcoin as a proxy for speculation. There's just not a lot of fundamental data involved, so it's really more about speculation and adoption and expectation for future utility for something like this, and really just whether people think the price should be higher or not, depending on their speculative approach, I guess I would say it. Does this mean this is dead as an indicator? Probably not. I would just say generally, if I'm looking for signs that equities are going to go risk off, there are a bunch of things I would look at before I would think of Bitcoin as a great indicator. And things that come to mind would be credit spreads, which tell you what the bond market's thinking, the VIX, which tells you what the options market are thinking. And I would say both of those arguably more closely related to and tied into the nuances of the equity markets than what the cryptocurrency market is telling you. And that's what we're thinking of here, right? Is the cryptocurrency market kind of up there with the bond markets and the options market? And I would say, no, this is a way down the list of things. Is how I would say it. So there you go. But again, we're hitting one of those times where the correlation has fallen to almost nothing here. And that's why it feels about right to ask that question. All right, we're going to come back to some additional questions here in a couple days. Again, all of those questions came from people like you over the last week or so. Please keep them coming. We appreciate it. Also, if you're in the typing mood, go to marketmisbehavior.com/seeking alpha. Thanks again, Seeking Alpha folks, for being great partners to Market Misbehavior. They're running a Valentine's Day sale this week, just into the weekend through Sunday. So please check it out. 15% off their premium offering, which allows you to get to their members only research, get to their proprietary quant model, their portfolio health check, and a bunch of other tools that I found pretty valuable. I put out a video earlier this week using their Dividend Aristocrat screen, which I thought was scan, which I thought was really, really cool. So check out more info at marketmisbehavior.com/seeking alpha. And thanks again, Seeking Alpha, for being partners to Market Misbehavior. Next question. Oh, that was the last question. That's a great final question. I want to save that one for the end. Let's get to another meaty one. Here we go. If a stock gaps lower, okay, bear with me as we discern these words together. If a stock gaps lower, then has a much lower close, I got it, and the very next day the stock's body engulfs the previous body, I got it, do you consider that an engulfing pattern? And I remember this question it was a much wordier question. I had to kind of boil it down to fit it on the screen, but you basically were talking about gaps, right? So there's a gap involved, right? And let me just zoom in because I'm going to use my hands for this one. If a stock gaps lower, so let's assume it doesn't matter really what trend we're in, right? But you're saying like a big gap down and then a down close, a lower open and then a higher close, and the gap is up here. And you're saying, does it still count as an engulfing pattern? So the short answer is yes, right? So candle patterns like that, at least bullish and bearish engulfing patterns, the gap is not super important because the idea is if we gap lower and have a down close and then have an up close, it doesn't matter that there was a gap or if it was just a steady trend. That 2-day pattern is what's so important because we opened and closed down, then we opened lower and closed much higher. And it's that 2-day reversal that's so meaningful. Having said that, there are candle patterns and other sort of bar chart patterns that involve gaps. And the island reversal is one of those that comes to mind, that literally is you have a gap, then you have some stuff, and then you have another gap higher. And so there's a gap on both sides. So here's the price action gap. Here's some price action gap. Here's some price action. That's a bullish island reversal. You can have the same thing with a move higher, gap, some stuff, gap. And so those two gaps creates a little island, like you're looking overhead at a map. And so island reversals are basically play off of gaps. In the candlestick methodology, right? We often, and I'm guilty of limiting it to just a couple patterns, because at the end of the day, there are hundreds of candle patterns, not cattle patterns, candle patterns. And if you read like John Murphy's books or Charlotte Kirkpatrick and Julie Dahlquist's books or any of Steve Nissen books on candle patterns, they've got great illustrated examples of these different patterns and what they mean. But I usually limit it to just a handful because there's just too many to follow all of them. But I would tell you that in the candle methodology, they actually do have a set of tools related to gaps. They call them windows. And I literally don't have enough to tell you about them at the moment. I can't add any much more to that discussion other than to say, yes, gaps are part of the candlestick sort of approach. It's not discussed very often, but they're called windows. And there is some discussion about where those windows are and what they might mean. I'll try to find a better resource for that because I didn't really think about it until just now. And if I can find something, I'll share it with you guys on the show next week. Maybe like a Steve Nissen thing. I'll have to look at some of that stuff. But the short answer is, in terms of the engulfing patterns, no, you kind of ignore a gap. And you really wouldn't include the gap as part of an engulfing pattern. It's sort of separate, at least as the best practices as I understand it. Yeah, this came, I think it was earlier this week or the end of last week. Can you show how you created the vertical bar that shows negative 52.3% in Bitcoin? And I totally can. Let me get to, I think it was on the chart of Bitcoin I have here. Yeah, you're talking about this guy right here, right? This 52.3%. Yeah, so this is a really good feature on stock charts. Honestly, most good charting platforms have great annotation tools, which is what I would use to generally describe trend lines, Fibonacci retracements, percentage change indicators, all of those sort of, just ways to visually, apply your own analysis onto the chart. I always tell people, think of a chart not like a painting, but like a workbook, right? It's your journal. It's a way to track your ongoing conversation with the markets. That's why I have a chart list with my daily chart of the S&P and a bunch of other things that are really important. And every day I'm looking at these charts. Often I'm adding a line or adding a circle or adding something. I don't put a lot of words on the charts, but if I was not, my business just involves showing charts to people too much, so words just kind of get in the way. But if I was just doing them for my own benefit, I would probably save words on the chart a lot more often. So the short answer is, how do you do this? So on stock charts, it's a couple steps. First, you click on annotate above the chart there. And then this little palette pops up on the left side. I'll zoom in a little bit so you can see them. And then it's actually, and full disclosure, I don't like where this is. And I've passed that feedback on, and I've clearly been vetoed. I brought this up years ago and I was told nope, but it's under this little letters, which, involves like notes and arrows, the percentage change tool, and a bunch of like Elliott wave counting tools. You click on percentage change, and then you just click on one point, you drag it to the next. And you can change like the colors and the thickness up there in the upper left. But that's how you do it. The other kind of quickie way to do it is on stock charts. There's this thing called the inspect tool. It'll give you these crosshairs. I don't use it much because I don't like that pop-up. It just kind of gets in the way for me. I'm a big fan of like clean charts. But if you left click and drag down, if you look to the far left side over here, it automatically shows you the percent gap from one point to the next. It doesn't hold it on there. It's just like a temporary thing. So if you just want to quickly see like how far are we below that early January low, like about 30% down, right? Because I can just drag that. And you can also drag to the right or the left, and it'll give you the number of periods over there on the far left side of things. That's called the inspect tool. So those tools are specific to stock charts, but most good charting platforms that I use, and other platforms that I've used heavily, are Bloomberg, which is what I used when I was learning technical analysis. They have a percentage change tool and things like that. Optima has good. Most good charting platforms have that kind of visual, percentage change thing where you can just look from one point to the next and show what's on it. So I don't use these often, but I use it if there's, like this. I just want to remember when I bring up the chart, like it's lost half its value. And if Bitcoin bottoms out in this general range, I'm going to look back and remember, man, when Bitcoin's down 50%, maybe I just want to be taking a shot at it. And that's in the back of my mind, which is probably why I'm leaving it there on my chart. It's a subconscious reminder that that's something I'm thinking about. All right, last question. And thanks for this. And this was someone that said, look, I think this would be a great Friday mailbag question. And I would wholeheartedly agree. What makes a good trader a great trader? I love that question. And what I love about that question, whoever asked it, is that implies that you recognize that there's a difference, right? And I will say, in my experience, and you can broaden that out to a good investor, a good technical analyst, a good market strategist. Too often, we feel like we've finally figured it out. Like at some point, everything clicks and you just don't have to work that hard anymore. That is not my experience. That is not the experience I've learned through the eyes of my mentors. And it's not been my own life experience as well as a market professional. I feel like I'm perpetually good at things and I'm always trying to get great. And maybe I'm eventually great and I'm trying to get, even greater. But I think recognizing that you can always improve, recognize you always have something to learn is super important. And that's a foreshadowing of what I'm going to share with you. So I think three things, right? I think number one is honesty. And I will tell you, just the fact that you're asking the question means there's an honesty to you, right? And what I mean by that is good traders tend to estimate their success rate. They tend to talk about how well they trade, and there's a bit of a gap between in real life how they're trading and what they're saying. I mean, think of it as like, you have your normal life and then you have the life that you share on social media, right? You don't share on Instagram or on Facebook that rough day when you don't eat well and you fight with your spouse. Like, you don't go on Facebook and talk about this interesting kind of rough day where you had these problems. You go on there when like, I was hiking in Ireland and it's really awesome. Check it out. Like, you share those really good days. And so it's a curated version of your life. And I feel like for a lot of traders, they're using that same lens for their trading. Their definition, they're sharing on social media their great trades, but the trades you learn from, the ones that are actually happening that don't go well, that's honesty, right? Is recognizing that a lot of your trades aren't good and recognizing you have something to learn. I think that's number one. Number two is humility. So humility means now that I know I'm not 100% accurate and I'm having some misses, being humble means I recognize that I'm part of the problem. Right? Good traders blame their mistakes on something or someone else. It's because of the Fed. It's because of the market. And I find with a lot of individual investors, they'll blame market manipulation. They'll make market maker, someone else. The man is, manipulating things, and that's why I can't do well. A humble trader, tries desperately to figure out what am I doing that's making me not be awesome sometimes, and how can I do better? And so I think humility is a big way to separate them, just to dig into bad trades and just recognizing, for me, it's like, one of the worst trades I've had in 2026, it's still early on. I got a lot of year left, but one of the worst trades was buying Bitcoin right here. I bought GBTC this week, and I remember doing it. And I'm like, this could be the beginning of this return back to all-time highs. I'm going to take a shot. Now, was it a failure? Like, no, because I got stopped out down here and I started taking some of the position off, and then I kind of took the rest of it off, and now I don't own Bitcoin anymore. So, for me, being able to admit I bought it there and that was wrong, what could I do differently? Like, how could I have thought of that? Is there something I missed? And that exercise of trying to recognize, is there anything that is within my control that I can change? That's where I found good traders become great traders, because they're learning from their misses. Last thing, consistency. And I will say good traders can be great traders for a small window of time, and it's more luck than skill, most likely. To be consistently good at trading, you have to have consistent routines. I always say consistent routines lead to consistent returns. And so if you're just kind of doing things haphazardly, you're rolling the dice, and sometimes it's going to work and you're going to feel like a rock star. But then it's not at some point pretty soon after. And so for me, great traders recognize that consistency matters, which is why I have a morning coffee routine every morning. I look at the same charts. I have a weekly routine every week. I look at the same set of charts and I do the same stuff. Once a month, I do a monthly chart review looking at a set of things. I do those routines not because I love routines. I actually don't enjoy being locked into routine, but I've recognized and experienced the benefits so much that it's important to me to make time to do those things consistently. Things like risk management, like documenting your trades, using indicators in a consistent way. Those are all part of the consistency game. Awesome question, and thanks for letting me have a little soapbox moment there to finish off the show here today. Thank you, all of you that submitted questions, and thanks to those of you whose questions I was able to feature on the show here. Really appreciate it. These are awesome, really good questions, and it shows that you're watching, and it's causing you to think more deeply about some of these concepts, and I'm very thankful for that. Never too late to add a question, so pop it in the comment section of our YouTube channel. We're going to be off on Monday. It's that President's Day. I think it's called the Washington's birthday holiday now. But on Monday, no market activity, no chart this with Dave Keller. We'll be back with our show on Tuesday. So have an awesome long holiday weekend. Be well, stay safe, stay warm. And remember, it's always a good time to own good charts. Take care, folks.